The savings rate that separates people who retire early from everyone else is exactly 25%. Not because 25 is a magic number someone invented, because 25 is the precise point where the underlying math of compounding stops running against you and starts running for you. I've done the numbers at every level. I know the exact year you retire, at 15%, at 30%, at 50%. I'm gonna show you all of it. And by the time we're done, you're gonna understand why the standard advice, max your 401k, save 10 to 15%, stay in the market, was never built to get you out early. It was built to manage you until 65. Take a percentage of everything you have and call it financial planning. Here's the uncomfortable setup. The Bureau of Economic Analysis reports a 4.9% personal saving rate for Americans in 2025. 4.9. That is not a retirement plan. That is a slow motion deferral of the moment you have to admit you cannot stop working. The people saving 4.9% are the same people who, at 62, look at a retirement account statement and realize it cannot support them. The magic number Americans think they need to retire comfortably in 2026 is $1.46 million. And the median retirement savings for those aged 55 to 64 is 18,500美元. There's a gap there. The gap has a name. It's called your savings rate. I'm going to explain 4 levels of savings velocity today. Call it the escape velocity framework. Because here's the metaphor that's going to follow us through this entire video. Getting to retirement is like launching a rocket. A rocket must hit a specific speed before Earth's gravity stops winning. Below that speed, no matter how hard the engines are burning, the rocket comes back down. Your savings rate works the same way. Below a certain threshold, the gravity of your lifestyle spending keeps pulling you back to work. Above it, and only above it, you actually escape. In a few minutes, I'm going to show you something that fundamentally changes how you think about investment returns. Because the most counterintuitive result in all of retirement math is not about how much you earn in the market. It's about what happens when you obsess over returns and completely ignore the variable that actually controls your timeline. Stay with me. There is a company called Vanguard that publishes something called How America Saves every year. It's one of the most quietly devastating documents in personal finance. It covers 5 million 401k participants. The average total savings rate, including employer contributions, hovers around 14%. Most people read that and think, okay, that's in the ballpark. Financial advisors say 10 to 15. Done, right? Wrong. Here's the reversal that almost nobody talks about plainly. You think low investment returns are your problem. They are not. Low savings rate is your problem. And the difference between fixing one versus the other is an order of magnitude. In 2012, a blogger named Mr. Money Mustache, real name Pete Adini, retired software engineer, published a post called The Shockingly Simple Math Behind Early Retirement. He wasn't selling a course, he was doing arithmetic. Using the 4% rule, he modeled how many years you need to work before you can retire at every savings rate, assuming 5% inflation-adjusted returns on your investments. What that math produces is brutal and beautiful at the same time. I'm going to walk you through the levels. At a 5% savings rate, you need to work for 65 years. That is not a retirement plan. That is dying at your desk while calling it a career. It would take 17 years to achieve early retirement when you save at 50% of your take-home pay. At 70%, 9 years. At 35%, roughly 25 years. At 15%, where most financial advisors pat you on the back and tell you you're doing great, you need about 32 years. Start working at 22 and you retire at 54. That's technically early. But it's also most of your healthy, high energy years already spent. This is the 4 levels of savings velocity. Level 1 is below 15%. You have not escaped Earth's gravity. You will work until you are physically unable to, or until someone makes that decision for you. About 58% of American workers say their retirement savings are behind where they should be, and most of them are in this level. Level 2 is 15 to 24%. You've broken the first layer of atmosphere. You might retire in your early 60s. Standard financial advice will tell you this is a win. It is not nothing. But it is not freedom. And one bad decade of returns too close to your planned exit date can eliminate even this. Level 3 is 25 to 49%. This is escape velocity range. You are on a trajectory to retire somewhere between your mid-40s and early 50s, depending on your return rate and lifestyle costs. The math is now decisively working for you, not against you. Level 4 is 50% and above. Those pursuing FIRE often aim to save a substantial portion of their income, usually 50% or more, to accelerate wealth accumulation. You are in orbit. A 17-year timeline from zero, the FIRE community lives here. Now stop and sit with a gap between level 2 and level 4. Same income, different ratio. At 15%, you work until 54. At 50%, you work until 39. 15 years of your life return to you. Not 15 more years of vacation, 15 more years when your back still works, when your knees hold, when your 40s are yours to design instead of sell. Here's the deeper point that makes the engineers in the audience put down their coffee. Your savings rate matters more than your investment return rate. Researcher Carsten Jeske, an economist who ran a sophisticated simulation using historical market data from 1871 through 2017, found that with a 60% savings rate, going from a 5 to an 8% return reduces your path to retirement by less than a year. Meanwhile, if person A saves at 60% and person B saves at 55%, even with person B getting an 8% return versus person A's 5%, their timelines are nearly identical, 12.3 years versus 12.2. The savings rate dominates. Investment return is noise by comparison. This is why the people obsessing over individual stock picks and which ETF has the best 5-year Sharpe ratio are often the same people who will work until they physically cannot. They are optimizing the wrong variable. They are fiddling with the rocket's fuel mixture while the escape velocity problem goes completely unsolved. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Here is where it gets really interesting, because 25% is not a linear milestone. It is a phase transition. Think about water. Water at 31 degrees Fahrenheit is very cold water. Water at 32 degrees is ice. 1 degree, an entirely different physical state. Your savings rate has a phase transition at approximately 25 to 30%, and almost nobody talks about it this way. Below 25%, the math is grinding. You're accumulating slowly, but the gap between what you're building and what you need to retire is so wide that you're depending on 30 plus years of uninterrupted compounding at your current spending level. Any disruption, a market crash in year 28, a layoff, a health event, a divorce, and the timeline blows up. You are perpetually one bad decade from never making it out. Above 25%, the gap closes faster than you expect. Here's the precise reason. Every dollar you save does two things simultaneously. It adds to your portfolio and it reduces the amount you need to retire because it proves you can live on less. At 15% savings on a $100,000 income, you're spending $85,000 a year. Under the 4% rule, you need $2.125 million to sustain that. At 35% savings on the same income, you're spending $65,000 a year. You only need $1.625 million to retire. You need substantially less, and you're building your portfolio faster at the same time. Both levers move simultaneously. That is the phase transition. That's the moment the game changes character. Now, there is a number that lives in my head rent-free. About 20% of retirees are working either part or full-time, according to T. Rowe Price's annual study. 1 in 5 retirees back at work. The top reason? The cost of living increased more than expected, cited by 51% of those who returned to work. Not the market crashed, not a medical emergency, just cost of living being higher than they projected when they planned to exit. That is a savings rate problem. That is a retirement funded below escape velocity. They crossed the finish line in a canoe, hit some chop, and got pushed back to shore. The healthcare piece makes this sharper. If you retire before 65, you are not on Medicare. You are buying your own coverage. According to the Kaiser Family Foundation, a 62-year-old purchasing unsubsidized ACA coverage, paid an average of $1,116 per month for a silver tier plan in 2025. That is $13,392 per year before any deductibles. If you did not model that into your retirement number, and most people do not, you have a hole in your plan that runs to $14,000 a year, every year, until Medicare eligibility. And it inflates every year you wait. This is the invisible bill that destroys early retirement plans funded below escape velocity. If you exited at 30% savings thinking you were done, you're probably fine with some adjustments. If you exited at 20% feeling clever, you just discovered exactly why 20% is still below escape velocity. Here's the honest confession. Knowing these numbers and building a system around them are two very different things. I had this same data. I've spent 10 years around accountants and fiscal lawyers who taught me how money actually moves. And even with that, having the framework on paper didn't automatically tell me what to do on the specific day I wanted to stop working. That's why I built the Exit Code. It's a digital book built on 50 years of actual retirement data, not opinion, not motivational content, 8 chapters of research. One of them covers what I call the $14,000 invisible bill, which is precisely the insurance gap I just described, calculated out across every scenario of early retirement before Medicare age. There's also a full breakdown of the dynamic withdrawal method, which replaces the standard 4% rule with something more durable for long retirements, the kind of 40-year retirement you'd have if you exit at 43 instead of 65. And there's a mathematical framework that takes I want to retire someday and turns it into a specific date with numbers behind it you can actually defend. You can get it for less than 1 hour with a mediocre financial advisor through the link in the description below. I'm not going to pressure you. The math is the urgency every year you wait at the wrong savings rate is compounding, working against you, not for you. Now, let me introduce you to Marcus, because Marcus is the subplot that runs through everything I just said. Marcus is 42. He's a sales manager making $95,000 a year. He's been doing what he was told. Since 28, he has contributed 10% to his 401k. 14 years of disciplined, consistent saving. His advisor checks in once a year, prints a nice one-page summary showing the portfolio is on track, and charges a 1% annual management fee for this service. Marcus has roughly $180,000 saved. He plans to retire at 65. Run the math. From 42 to 65 is 23 years. He's saving $9,500 annually. At 7% return, a reasonable, slightly conservative assumption, he accumulates roughly $560,000 in new contributions and growth. Add that to his current $180,000, compounded forward, and he arrives at 65 with roughly $850,000. He currently spends $85,000 a year. Under the 4% rule, he can sustainably withdraw about $34,000. That is a $51,000 annual shortfall. Marcus is not on track. Marcus's advisor has never shown him this specific slide. And Marcus has a 1% advisory fee compounding against him on every dollar he has ever saved. Here's what that fee costs in isolation. A 0.50% fee difference on a $100,000 investment costs approximately $165,000 in foregone wealth over 30 years. Eliminating a 1% advisor fee could save over $1 million across 3 decades, according to analysis looking at larger portfolio scenarios. That is not a typo. Every annual fee extraction sets off its own compounding chain of lost growth. And the earliest extractions produce the largest losses because they have the most time to compound. The fee is not taking a slice of today's money. It is removing the seed capital for tomorrow's compounding, year after year, quietly. The incentive structure here is worth pausing on. Your financial advisor charges 1% of assets under management, not 1% if and only if you retire on time. 1% of assets, period, whether you retire at 50 or work until you collapse. A 1% difference in fees can mean working 5 to 7 years longer before retirement. An advisor who told Marcus the following: "Your savings rate is the real problem. Here's a plan to double it and fire me in 10 years," would be the most honest person in the room. That conversation has a near zero probability of occurring if the advisor gets paid on assets. I don't find this enraging, I find it clarifying. The system was not designed to produce escape velocity. It was designed to manage assets until 65, charge a percentage of everything you accumulate, and call it a partnership. This is where the conventional playbook falls apart entirely. The savings rate during working years is a crucial factor. Traditional savers might save around 10 to 15% of their income, whereas FIRE investors often save 50% or more. The traditional playbook is mathematically sufficient if your goal is to retire at 65. It is mathematically insufficient if your goal is to retire at 50 or 45 or 40. At those timelines, you need escape velocity, and the traditional playbook doesn't even introduce the concept. Imagine going to a NASA engineer and saying, "I want to get to the moon. What do you think of my bicycle?" And the engineer nods thoughtfully and says, "That's a great bicycle. You should keep pedaling. Maybe get the one with a suspension upgrade." That is the 10 to 15% savings conversation. Perfectly good advice for an entirely different objective. There's also the sequence of returns problem that nobody mentions when you are below escape velocity. If Marcus retires at 64 with $850,000 already underfunded, and the market drops 30% in his first 2 years of retirement, he is down to roughly $595,000. His withdrawal rate was already a problem. Now it is a catastrophe. The instinct is to blame market timing. The real cause is arriving at the starting line with insufficient fuel. A higher savings rate does not just get you there faster, it gives you the buffer to survive a bad sequence of returns at the worst possible moment. About 58% of American workers say their retirement savings are behind where they should be. And yet, only 28% of American workers are very confident they will be able to retire comfortably, according to a 2025 survey by the Employee Benefit Research Institute. The math on that confidence level is generous, by the way. 28% may be too high. This is where the behavioral piece enters, and this is the one I think about most, because the math is genuinely simple. 25% instead of 5%. You do not need an algorithm. You do not need a Bloomberg terminal. You need a fraction. So why doesn't everyone do it? The honest answer is that human brains were not built to optimize for exponential futures. Behavioral economists call it hyperbolic discounting, the tendency to dramatically overweight the present relative to the future. The most famous demonstration is Walter Mischel's Stanford marshmallow experiment from the 1960s. Children sat in front of a single marshmallow. Eat it now or wait 15 minutes and get 2. The children who waited showed measurably better life outcomes across decades. The children who ate immediately were not stupid, they were human. The immediate reward is vivid and present. The future reward is abstract and uncertain. Your savings rate is the adult version of the marshmallow test. The new car, the nicer apartment, the vacation, the dinner out. These are the marshmallow. The additional 15% you could have redirected into index funds instead is the second marshmallow. And your brain, running on architecture that evolved before stock markets existed, is working against you every single time. The mechanism is what economists call lifestyle inflation. You get a raise, your income goes up. Without deliberate intervention, spending goes up in near perfect lockstep. Within 6 months of a raise, research from Fidelity consistently finds that most workers have redirected the majority of the increase into consumption rather than savings. The savings rate barely moves. The lifestyle, however, upgrades. The slightly better apartment, the streaming services, the car lease that's marginally more than the last one. The trap is called the hedonic treadmill. You get more, you adapt, you want more. At every income level, the feeling is identical. Just a little more income, and then I'll be comfortable enough to save more aggressively. But the goalposts move as fast as your income climbs. Most people never voluntarily step off the treadmill. They wait for the treadmill to break. And at 62, with $185,000 saved and $14,000 a year in health insurance premiums, the treadmill breaks in the worst possible way. There's a woman named Tanja Hester. She's the author of Work Optional and one of the more rigorous voices in the FIRE community. She retired at 38. not from a tech salary, not in a cheap city. She and her husband hit their number by sustaining a savings rate above 50% for several consecutive years. Hester and economist Karsten Jeske advocate for a conservative safe withdrawal rate of 3.5% or less for early retirees, rather than the standard 4%. The 4% rule is not wrong. It was designed for a 30-year retirement. Hester is planning for 40 plus. The same math calibrated for a different race. Now, here is the mini case study I promised, using real numbers. Two people, both 35 years old, both earning $110,000 per year, both starting from a $50,000 existing portfolio. Call them Alex and Jordan. Alex follows standard advice, saves 12%, $13,200 per year, lives on $96,800 annually. At 7% real return in 30 years, Alex's portfolio grows to approximately $1.9 million. Alex retires at 65. Jordan decides to operate differently, saves 35%, $38,500 per year, lives on $71,500 annually, drives a used car, eats lunch at the office 5 days a week, does not subscribe to 7 streaming services. At 7% real return, in 25 years, Jordan's portfolio grows to approximately $2.5 million. Jordan retires at 60, 5 years earlier. With a larger portfolio and a lower spending target, meaning Jordan's portfolio can actually support retirement where Alex's is stretched thin, the difference is not intelligence. It is not market timing. It is not a lucky IPO. It is the savings rate running consistently across a decade of daily decisions about where money goes. Let me bring Marcus back for the resolution. Marcus is 42. Savings rate, 10%. Trajectory to underfunding. Here's the single decision that changes everything. Marcus bumps his savings rate to 30%. He cuts $21,000 of annual spending, the restaurant dinners, the German car lease, the gym he stopped using, the upgrade on the apartment he does not actually need. At 30% savings, Marcus is now redirecting $28,500 annually into his portfolio. At 7% return over 20 years, with his existing $180,000 already compounding, Marcus can exit around 62, not 65. And his portfolio arrives at 62 in considerably better shape because the spending reduction also reduced what he needs in retirement. Marcus makes one decision, one recalibration. The math shifts. He does not need to go full fire. He does not need to eat beans and rice for a decade. He needs to cross the escape velocity threshold and stay there. 3 specific takeaways calibrated to exactly this conversation. First, calculate your actual savings rate today, not your 401k contribution rate. Your total savings rate, every dollar going into every investable account, divided by your take-home pay after taxes. Most people have never done this precise calculation. They think in contribution percentages, but not in terms of total household savings velocity. Run the number. It will probably be lower than you think. Now look at the table I described and find your retirement year. Let that number land. Second, every 1% increase in your savings rate that you achieve in the next 12 months permanently changes your retirement date by more than 1 year. Not 1 year, more than 1 year. Because savings rate simultaneously moves the accumulation rate and the retirement target. A jump from 10% to 20% does not shave 10 years off your timeline. It can shave closer to 15 because you need substantially less portfolio to sustain a lower spending retirement. You are moving both ends of the equation at the same time. This is the math nobody shows you in the target date fund brochure. Third, audit your fees the same way you would audit a hole in your income. At a 1% annual fee, a $100,000 investment over 30 years ends up at approximately $761,000 versus $995,000 at a near zero fee. That $234,000 gap is not the market's fault, it is the fee. If you are in actively managed funds with a 1% or higher expense ratio stacked on top of a 1% advisory fee, your total annual cost could reach 2 to 2.5%. A 2% total fee portfolio leaves you with 5% net growth, and over 25 years, that is nearly $1 million in lost wealth. A simple, low-cost index fund with a 0.03% expense ratio is not glamorous. But glamour does not compound. Assets compound. The median American aged 55 to 64 has $185,000 in retirement savings. 28% have nothing at all. Those numbers are not the result of bad markets or bad luck. They are the result of decades spent below escape velocity, saving just enough to feel responsible, not enough to actually get out. The tragedy is not that the math is complicated. The math is straightforward. The tragedy is that the system surrounding you, the advisor compensated on assets, the brochure optimized for compliance, the cultural script that says max your 401k and wait your turn, was never calibrated to produce escape velocity. It was calibrated to manage assets and keep you in the workforce for as long as possible. Lazy investing built more fortune than crypto memes. The canoe is still moving. It's just never going to reach